The return of Donald Trump to the White House has shaken up the world massively, and the S&P 500 has responded with its first market correction, that is, a drop of 10% or more from a recent high, since October 2023. And many investors have been spooked by Trump's erratic trade policy and general unpredictability, leading many investors to consider selling their holdings before the markets get worse. But is this actually a sensible thing to do? Should we consider selling our holdings in the S&P 500, or at the very least hold off on investing more, in order to protect ourselves against Trump's unpredictable and potentially damaging economic policies? This video will discuss these questions, and we'll talk about how you can potentially capitalise on an unpredictable and volatile stock market. If we take a step back to 2024, before Trump was elected, investors were beginning to agree that the S&P 500 was becoming overvalued, as in the share prices of the companies which make up the S&P 500 were rising faster than the profits of these companies. And this basically meant that the S&P 500 was expensive and was probably due a period of decline to bring it back down to a more realistic valuation. But then came the US election in November, and we saw an almighty jump in the S&P index as a result of Trump's victory, as investors were hopeful that the Trump administration would bring in policies such as low business taxes, less regulation, and would generally try to create a more friendly environment for businesses to operate in. And this rally continued for a good few months, right up until the end of February, when we started to see a stark turnaround in the markets as Trump's threats of a trade war started to become reality, with tariffs going up left, right and centre with America's biggest trading partners. And this is basically where we are now, with the markets down and investors spooked by Trump's erratic and unpredictable tariff policy, which many people believed wouldn't actually happen, as Trump was just using the threat of tariffs as a bargaining chip. But at the end of the day, we're actually just a bluff. However, this has turned out not to be true. But there's also a much deeper theory which is circulating among investors at the moment, a theory which suggests that the American president might actually be trying to deliberately crash the US economy. Now, this might sound ridiculous at first. Why the hell would the President of the United States deliberately and willingly crash his own economy? Well, here's the story that some people are telling. The first thing that you need to understand is that Donald Trump hates high interest rates. He's on the record complaining about them many, many times, and argues that they slow down businesses and the economy as a whole, which in many ways is true. And he also hates high interest rates because the US is drowning in $32 trillion in national debt. And like any other debt, they need to make interest payments on this. And if interest rates in the economy are high, then the interest payments that the government will have to make to service their debt could be a ridiculous sum of money. And this is exactly what's happening at the moment. As you probably know, interest rates around the world have gone up, especially in Europe and America, in order to tackle the bout of inflation that we've experienced following COVID and the Russian invasion of Ukraine, as well as other things. In fact, America is drowning in so much debt, and interest rates have gone up so much that the US government is now spending more money on interest payments to service its debt than it is on its military, which is absolutely crazy. So if Trump can somehow get these interest rates to come down, then the US government will save tens, if not hundreds of billions each year on their interest payments, which would be a major win for someone like Trump. But as many of you will know, the interest rates within an economy are in large part controlled by the central bank, which is often independent from the government. So the government has very limited control on where the interest rates go. For example, in the US, the central bank is known as the Federal Reserve, or simply the Fed, and is completely independent of the government. So Donald Trump cannot say to the Fed that they need to cut interest rates. The Fed will make their own mind up on where interest rates will go. And the Fed will only cut interest rates if it sees the US economy start to slow down. As if it starts to cut rates while the economy is performing well, or even just ticking over, then this risks ramping up the inflation rate yet again. So in other words, Trump can't directly change the interest rates in America, but he can try and change the things that the Fed will consider when they decide where the interest rate should go, such as the general strength and performance of the economy. So the theory goes that Trump is trying to deliberately crash the US economy in order to force the Fed to start cutting interest rates, so that the government will save tens, if not hundreds of billions of dollars on the interest payments on their $32 trillion of national debt. Now, personally, I've got lots of problems with this story. However, this isn't a politics channel, and I'm not here to take sides. But the fact is that many investors are buying into this story and are genuinely spooked that the President of the United States is trying to deliberately crash the US economy, and are therefore seriously considering selling their holdings in the S&P 500 and moving their capital elsewhere. But before you rush off to do the same, I think there's a really important point that I think we all need to bear in mind. So, let's just take a second to remember that no one knows what Donald Trump plans to do. After all, this theory about him crashing the economy on purpose is pure speculation, and at the end of the day is just a compelling story. And I think it's also important to remember that short-term movements in the stock market are influenced by many, many different factors, which makes it really hard to predict. In fact, it's often difficult to attribute short-term movements in the stock market which have already happened to recent real-life events. For example, it's probably true that Trump's tariffs and general unpredictability have caused this market correction that we've seen in the S&P 500. However, it's impossible to say this for sure, and it would be very, very difficult to prove. So what I'm trying to say is that if we can't say for sure how recent events have affected the stock market, how the hell are we supposed to predict the short-term movements in the stock market based on events that haven't even happened yet? Sure, it's fun to tell stories about how the US president might be trying to deliberately crash the economy, so the stock market will then crash as a result. But at the end of the day, this is just a story, and no one has any idea how the stock market will move in the short term. Getting to grips with the fact that the stock market over the short to medium term is almost entirely unpredictable can be pretty intimidating. After all, it's human nature to hate uncertainty, especially when it's our hard-earned cash which is at stake. But when it comes to investing in the stock market, it's really important that we accept this unpredictability and try to think of it as the cost of investing, as in you have to accept the short-term ups and downs in the market in order for the chance to be a part of its long-term growth trajectory. And I think this point is really key. If you're a true long-term investor, you'll probably have a 10, 20 or even a 30-year time horizon before you even think about cashing in your investment and actually using it, by which time the effects of Donald Trump's erratic economic policy will hopefully be a thing of the past, and you'll have reaped the rewards of the long-term growth that the US stock market has hopefully provided over the years, like it's provided for many decades in the past. And it's at times like this that we really need to fight back against our natural psychology, as human nature will tell us to invest more when prices are high and markets are doing well, and to sell and cut our losses when markets are performing poorly. But in reality, we actually need to be doing the opposite, as when markets are down, we need to be investing more, as we can actually invest at a discount. So in my opinion, one of the best ways that investors can capitalise on a volatile stock market is to use a technique called dollar cost averaging. And you may have heard of this before, but essentially it means investing a consistent amount at consistent intervals, say £200 a month for example, as this gives you the opportunity to invest money at a discount if the market falls, but you'll still be reaping the rewards if the market rises. So it's an ideal technique to use in situations where the market is volatile, as you'll be getting some sort of benefit if the market falls and if the market rises. And also, this is a really nice technique because you can just set it up to happen automatically. For example, there are many investment platforms which allow you to set up a direct debit to invest a consistent amount at the end of each month. So you can just set it and then forget about it, and you don't need to worry anymore about the short to medium term movements in the stock market. However, if you're thinking that Donald Trump's erratic and unpredictable economic policies might genuinely risk the long-term sustainability of the US economy and the US stock market, then there might be something that you can do to sort of de-risk your position slightly. And this would be moving your investment from the S&P 500 into a global index, which contains the largest companies around the world, not just the largest companies in America alone. And what this will do is it will de-risk your investment slightly away from the US stock market and the US economy, as you'll now be exposed to the stock markets of the world as a whole. And moving from the S&P 500 to a global index isn't actually as drastic as you might think, as global indexes typically are made up of around 65% of US stocks anyway. So you've gone from 100% holdings in US stocks to 65% of US stocks. So you're not exactly selling, you're just diversifying your investment slightly. If you've made it this far, you might find some of my other videos on the channel interesting, as we've got many more on the topics of investing in personal finance, like the one on screen now. And if you've got any questions for me, please leave me a comment below and subscribe if you've enjoyed. Thanks for watching.